Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither Phil Stockwell.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
All right. So let's see where we are today. We've got oh. Hang on. All right, we'll bring up Thinkorswim. We'll see what goes next. The indexes are same topping outs. Look, I mean, since last month, we've been topping out basically up here all the way across. So it's not exactly strong. Even Japan, even Europe, it's all the same. So, you know, I mean, I think we're kind of hovering into the China deal. I don't think the Fed matters. The Fed's coming in. Don't forget the Fed's on at 2 o'clock. But I don't think the Fed matters. I think it's really about whether or not we do this China deal or not. So let's see, we get some charts up here. Yep. So overall, if we look at the weekly view, let's get rid of this now. It's nice to know that it's there. If we go to like the view of the week, we've been sort of plodding along. When did we do the last webinar last week? That was the 4th. So here we were last week, and since then we've gone up a little bit, but nothing exciting. And portfolio-wise, Hemboka is still down a bit. It's mostly being killed by this MJ trade, which is costing it $9,000. 20, you know, this is a 20% loss for the portfolio. So everything else is up 20%, unfortunately, with that one bad position. Butterfly, obviously chugging along as usual, 104 at the moment. Dividend portfolio, hopefully doing nothing, which is what it's supposed to do. Wow, that's a lot. Why is that? That seems like quite a lot of money to make in a day. I mean, our goal for the year is 37%. So it's kind of, not even our goal. Our potential for the year is 37%. So this is a little weird. Oh, no, actually, that's not true. We added some trades and we didn't do a new total. So the total for the year is probably higher now. So that's probably why. That explains it a little bit. We could be up to 60% for the year. I'll have to redo the numbers next time we do a review. Okay, so who's winning it? These guys are flat. This is a winner. Energy Transfer. Ford's a little bit of a winner. This is a big winner. Macy's. Gotta love Macy's, right, guys? when I'm sure you're sick of hearing me bang the table on, but for God's sake, look, I mean, this is why. You know what it is? They were priced, the options were priced for a wild swinging stock, and it's very, very much to our advantage when that stops happening. So the stock went up a bit. They're no longer being priced for bankruptcy, and that's destroying the value of the puts. The calls haven't changed much, but the puts have gone straight down. Philip Morris, also big gain on the stock. Annaly, gains all across the board, very nice. Signet with a nice, big win here, big loss here. That's fine though. That's the call spread because we were conservative. We're so conservative. We're actually going to get called away on this eventually because we sold the 13 puts and calls back in October and they have flown up. That's kind of crazy. So that's one of the reasons, because we're catching a lot of the gains that we would expect from that. So in October here, we conservatively sold the 13 puts and calls, but they've gone flying up since then, like 20-something% or 30%. So that's just off to the races. And here's Tangier Factory Outlet, which is still the best, still buyable. It's still below where we came in. And even AT&T has made some money. So this is, again, without even the dividends being paid in yet. I think only one of these stocks so far has actually had a dividend come in. We started this thing on October 25th. All right, so just over a month ago, or let's say a month and a half, whatever. You could not have been more conservative in our picks, in the type of stocks that we picked, in the positions of the stocks that we picked, and it's making 11.8% already. I mean, this is why I still see so many people gambling and talking about all these, weird little stocks and these small stocks and these stocks that are brand new and things like that. And I mean, it's fine to gamble with and play with and stuff, but if you're a real portfolio, if your main portfolio where you're putting most of your cash and you're investing in your future, you can make so much money with nice conservative strategies like these instead of taking big risks. It's just pick up solid companies and make solid plays on them, and you can do very well. I mean, this is a crazy amount of money. This is not a normal amount of money to make in a month, obviously, but it is possible. That's what I'm saying, though. I mean, in the same good market that lets you make money on these dopey stocks, you could make money on normal stocks, and then you don't have to worry about them so much if the market isn't so good. So that's our dividend portfolio, the super conservative. So the butterfly is doing well, the dividend's doing well. Earnings portfolio, not so well, 3.2%, but we have a lot of solid positions that we like. This is weird. How are we only up 3% when I can see visually 12 plus 25 plus 12, 13, let's call that 2,000, 4,500. Another 5 is $10,000. We're up $10,000. And here's minus 13 and minus a couple more is minus 2 is 8. We should be at 108. That's kind of weird. It's a brand new portfolio. I don't remember taking any huge loss in the earnings portfolio. I'm going to check that out. Something might have been misentered or something might have happened. It seems like something went wrong here because we should be up much more than this. Let's see what else we can get into. The hemp Boca portfolio also being held down by MJ, just up 2%. And that's because we have this big ass loss here. I think, did we already say that? But anyway, everything's going well except for this guy. So this MJ ETF is really hurting. All these cannabis companies are having problems. Money Talk portfolio, that's only up 2%, not really doing much either. But that one makes sense. That looks like $2,000, so there's perfect sense to that. We have gold. Our trade of the year is up a bit. and IBM is really going nowhere. And some power puts have actually started underperforming a little bit. So this whole portfolio is good for a new trade. And then last of all, the aggressive short-term portfolio, and that's up 60% in 2 months. I guess they're all winners. CBS winner, Booking winner. Oh, where is Booking? 1920. They're right. They're right where we want them, aren't they? Yeah, we sold. Okay, we sold these short puts, so we want them above 18, and our target long term is 19. So perfect. Freeport is a winner. MJ, in this case, is still a loser. I don't know why I keep playing it. It's one day, I'm telling you, one day. So MJ is still behind. MO, big winner. TLT, winner. But where are we? This is this January coming up. We have the 148. Well, yeah, we have the 148, 140 spread. The Fed's coming today, so we'll see what happens with TLT. And we sold the 145 calls. Those aren't coming in, so I like this spread still. And we have Tesla, and we actually recently added, a couple of days ago, we added CMG. We did another short CMG play, which is set up kind of like the Booking play, but hasn't been logged in yet. So Tesla's perfect, going perfectly. And so that's all good. So I mean, an incredible winning percentage, especially considering we have longs and shorts. So we're winning on both sides. We're doing good, very good for a stop picking market. Today in the chat, we talked about, where are we? Little stock world. So well, first of all, in chat today, we went over the 5 trades to make $25,000 in 5 months that we originally had put up in. We consolidated it into an article on August 29th. And if you look into the article, though, you'll see that each one has its own day. So during this week or the week before August 29th, we started talking about, I said, I want to put together 5 trades. I talked to the members in chat and said, look, I want to put up something because we were going to close our long-term portfolio. I said, well, just in case I'm wrong and the market isn't crashing, which it didn't, I said I want to pick 5 plays that will make $25,000 in 5 months, and obviously proportionally, but I set this proportion up for a $100,000 portfolio. So I said, worst comes to worst, you can take money, put it in these trades, and make 25% in 5 months. So from a proportion perspective, we did this for a $100,000 portfolio officially, but if you had $1 million, you could have just done 10 times as much. The point was that making 25,000 between August, whatever, the end of August and the end of the year would make up for the fact that we cashed out our main portfolios. So anyway, so we went over these today. I'm not going to do it again. That was our whole post today, but this is our post today, actually. So we had VAC, which is a Marriott Vacation Club. They went flying. This, interestingly, when we did this was August 20th. They had crashed out down here. And there was news on August 20th about, I forgot. I forgot what the news was. It was like I'm mixing up my news with Booking. But there was some news right on that day. And I said, well, that should be good for something like the Marriott Vacation Club. And I decided it was a good time to buy it. I'm well aware of this because I'm in the Marriott Vacation Club too, so I'm well aware of their activities. And I said that they didn't have long options. That's one reason we don't usually play them. But I said it's a good time to get in, and the price of the play was well. So we did that. That's a huge winner. Obviously, it's already through the roof. I reiterated it on the 29th. I said you can do this one instead, which was a slightly different trade. And obviously that one also is in the money and did well. So this one was net 1525. And, that was our original play. This was the newer play. I changed the numbers for the newer plays. The second one was 820. Oh, that's interesting. All these trades, I get it. All of these trades are new numbers. I didn't realize I did that. So every trade you see here was a new number from the 29th. We had better numbers in the member chat room. See, I said, I'm going to post those trades along with links to our original logic, but updated prices as of yesterday's close, because that way somebody who's reading this article on 8/29 who wasn't a member could actually make all these trades. You know, because once in a while we like to show off what we can do for people if they want to become members. So in other words, there was an original trade on 8/20, but as of 8/29, the position was this. So the numbers I actually went through today, I forgot that fact. So the numbers we went through today are less than what we actually made in these positions. Doesn't matter though. It's just that we hit our goal. That's all that matters. So this one, for example, started out at net 1,500 and now it's net 2,190. So we had already had $600 in our pocket before this one started. It's the same trade. I mean, it's a matter of timing of when we got in. So this one also, and so these are just on the 29. These were the updated prices. We had already made money. So that was Walgreens. We like them. We just reiterated that one lower down below. LB also hasn't gone anywhere, so we're able to get into it again for a new trade. We made our money. You know, we still made our money here because we played it to be flat, and it was flat. That's exactly what we said it would do. THC blasted through the sky. That one we didn't think was going to go up so fast. It really was aggressive. But either way, again, we don't care. But that means that we're not going to play it again. This one's gone. It went away. We're not interested. I don't want to play. Even if I like Tenet Healthcare, 50% more than where we just bought it for a few months ago doesn't appeal to me. I'll wait. There'll be something. There will always be something else on sale. You don't have to go after things just because you like the company, just because that's why we make these watch lists, because we want a list of 20, 30, 40 companies that we have on a watch list. And that way we can always go back to our list and say, okay, who's cheap now on our watch list? Which of the 30, 40 companies that we really like in this market environment do we want to pick this week if we want to add a trade? And remember our discipline when we have a long-term portfolio, which we do not right now, but in the long-term portfolio, one thing we do every single week is we find a stock to sell puts on. We have a $500,000 long-term portfolio, and every week we try to sell $5,000 worth of puts. So I'm sorry, every month, sorry. Every week would be crazy. Every month we try to sell $5,000 worth of puts. So that way, in a rotation of 2 years, because we're generally selling 2 years out, we will always have about $100,000 worth of short puts that will expire every year. Half of them expire, and we add a half more. So at most we'll have we could have up to 36. But then if they go, sometimes we cash them early, sometimes we stop out. But generally we'll have somewhere in the range of 18 to 30 short puts at $5,000 each. So maybe 150,000, 100,000 worth of short puts. That's one thing we do every month to make sure we always have a little bit of income coming in. But we sell a put in whatever stock that we have on our watch list or whatever stock we think is an exciting bargain, and that's how we keep an eye on it. And from that, then we often decide, okay, we're going to expand on that one. And usually it's because it goes lower. Because I'm like, well, I liked it well enough to sell a put at such and such a time, and why did it go lower since then? And if I think it went lower for dumb reasons, I'm very likely to start adding a more bullish spread to the thing, turn it into a bigger play. But selling a put's not a huge commitment, especially when you sell a bit of it. In this case, we sold 10 THC January 20 puts for $250. I'd love to own THC for $17.50. It ain't gonna happen. But if they want to give it to me for $17.50, I don't have a problem with that. So that's what we do. We start our trades with short puts. SKT Tangier Factory Outlets, same thing. We sold the $12.50. We sold the $15 puts for almost $2. So we're kind of netting in at 13. As you can see, it never got to 13. We did this trade on Friday, so it must have been last Friday. It must have been like the 20. Well, about 6 days earlier, so the 23rd. So Friday the 23rd of August, somewhere down here. And I know it looks scary. I enter stocks when they still look scary because I don't really care what the chart looks like. I care what the value of the stock is. And so when it got to that level, I said, bullshit, that's ridiculous. And I decided that we would make a stand there, and it worked out fine. It became a little bit, and it often goes against us at first because I'm not perfect. I'm not making perfect calls. I'm just picking a stock because I say that now has gotten to a point where I absolutely want it. And I said up here, it took a deeper hit today to 14.29. I just did a whole top trade right up on them August 1st, $1 higher. So no need to get into that. But okay, so hey, that's interesting. Now let's take a look at that. Let's look at the top trade. That is an interesting concept. Top trade. And now we'll find it on August 1st. Because this will be a big write-up. I remember doing it. October. Wow, we do a lot of top trades. You know, it's unfortunate because that's become our most popular membership. We have so many top trade members, but the problem is they don't chat. And our chat has gotten quieter, and we have a lot of members, but they're the wrong, they're not the chatting ones. And I got to figure out a way to address that somehow because I'd like to have a few more people in chat. Or a few more active people. There are actually quite a lot of chat people, but probably it's gotten to the point where like probably 95% of the people who are chat members don't participate. So I wish there was a bit more conversation in chat. I love the guys who do participate on a daily basis, but just a little bit more conversation would be nice. Like throw a few more ideas out there. Just say, hey, what do you think of this company? It's like you don't have to have a big conversation, but say hello. Top trades for August. Okay, it's SKT. So here's my thing, and I still pounding the table on this stock. Obviously, we just reiterated it today. So this was a top trade alert, August 1st, midday, and they had just announced their earnings, which I thought were fine, and the stock took a hit. Obviously, a very sharp hit. Nobody else seemed to think they were fine. I thought it was perfectly good. They beat by 3 cents, missed on revenue. And it's like, oh, for God's sakes. It's, they missed on revenue. People think they're going to go out of business. But here's a great thing. I don't know how well you guys can see this, but look at the stores. Ralph Lauren, Michael Kors, H&M, Nike, Calvin Klein, Under Armour, I think that is, J. Crew, I don't even know what that is, Eli Tahari, Vince Camuto, Banana Republic, Gap, Chico's, Nautica, Columbia, American Eagle, Clark's, Naturalizer, and God knows what that is. So of these, Nike, solid, right? We know that. Kors, not in trouble. Ralph Lauren, not in trouble. Under Armour, in good shape. J. Crew, not public, or unless they're part of something, I don't know. Eli Tahari, don't even know who that is. Camuto, don't know. Banana Republic, don't know if I don't think they're public. Chico's is FAS. They're iffy. These guys are iffy. Gap, I would have to call Gap iffy. I think they're probably solid, but I wouldn't say they're rock solid as far as a tenant. Nautica, not a problem. Columbia, not a problem. Clark's not a problem at all. American Eagle, big problem. That's one I'd be worried about actually. Naturalizer and whatever that says. So, they have a good variety of tenants, and the best thing about these guys is they're not very tenant heavy on any particular place. These are all their different locations. They're geographically spread out. They don't get killed if one region has a problem. Although they are obviously East Coast-ish. Here you go. This is what I love about these guys. Strong and dynamic, and they care. This is something they actually care about. These are their biggest tenants. So I don't know what a center retail is. They got the Gap, Philip Van Houston, Under Armour, Nike, Tapestry, American Eagle. So if American Eagle does go bust, it's 2.5% of their space. They'll just re-rent it. It's not that hard. It's not like malls. Most, and that's the thing. They're priced as if they're a risky mall retailer, REIT. And the mall REITs have problems because they have huge amounts of space rented out to JCPenney's, Macy's, whatever. And if one of those guys goes bust, they're just totally screwed. Not only does that store become almost impossible to fill, because like in in Wayne, New Jersey, we have a mall, and it's a huge mall, and it's very crowded all the time. But they lost Sears, and even though the rest of the mall is packed and you can't find a parking space in the whole place in Christmas time, I mean Christmas time, like for the whole month of December, basically. You have to. I mean, it's horrifying how much you have to walk. They've got a Bloomingdale's. They've got they don't have a. No, they do have. I think they. I don't know if they have a Macy's or not. They have Bloomingdale's. They have some other big store, but they've got 100+ other stores in this place in Wayne, and but Sears went bust, and they can't find anybody. There's who's that big who's going to go into these places. You know, who's that big who's expanding and looking for space? Nobody. So these malls are trying to figure out what to do with the spaces and cut it up and this and that. But meanwhile, it's a giant gap in their balance sheet. But Tangier isn't like that. They don't have any single large tenants. They did that on purpose. They don't want it. They don't want to fall into that trap. And you can see their occupancy. This is going back 2 crises, right? We have the 2001 crisis and we have the 2008 crisis. And 98, 96, 97, 98, 99, 98, that's their occupancy rate straight across. This is their business. All right, so what's the other variable? So demand isn't a problem for them. They're selling all their inventory. This is their inventory, 96% sold. Their inventory is the stores, right? Is the amount of space that they have. They're selling all of their inventory. And if they're selling all of their inventory, they're making good money. Now, the question is, at what price are they selling their inventory? Are they discounting heavily or anything like that? And no, they're getting good prices for their inventory too. I don't know if they have that slide up here, but they're doing very, very, very well, doing everything they need to do. They've got very manageable debt, no particular problems coming up or anything like that. And and also another thing you like about them as a REIT is that they are proud. When you see slides like this, that's good. That means they care. They like their dividend growth. They want their dividends to be solid and long-term and increasing over time, which makes them great to own. And earnings are rock solid. Net income, 71 cents a share, 45 cents a share. It's like there's nothing wrong with what they're doing. And so that was my whole write-up as a long-term portfolio play. Now that was back in August 1st. Now where's that thing we were looking at? Yeah, here. So so that was here. And I thought this was going to be a bottom, and it wasn't. Okay, so they had bad earnings. I said I think they're going to hold 16, and ultimately they do hold 16, but there is a little bit of pain in between. It went down to 14, but that's okay because the plays we take a long-term plays. We don't know exactly when they're going to bottom, but I do know that 16 is a fair price given the information we had on hand. So that's where we planted our flag. And that's why these places, like, it doesn't pay to watch every single thing they do and panic over things. It's like, well, give it 6 months, give them 2 earnings reports, see what comes up. Anywho, so what is this anyway? Oh, that's the original. I'm sorry, that's the original article. So we're done with that. And then today, this morning, how are we doing on time? Half hour till the Fed. So then this morning we went over it. Everybody's a winner basically. They're already up $25,000, which was our goal. So we're done. But I said, look, the ones that didn't go anywhere, SKT has been flat, LB has been flat, and WBA has been flat. So we set up 3 new trades that will make a total of $18,350. And the expiration dates are March, June, May, and April. So basically over the next few months, or in the first half of the year, we'll make another 18,350. Now again, if you had a $100,000 portfolio and you did the first set of trades, you made 26,000. Made $26,875 in gains so far, and that's in 4 months. So now we're going to put $6,400 back to work of cash. Same thing we did last time, except now I'm only picking 3 trades, and my margin is only, and my potential is only 1850. But that's going to mean that it doesn't matter what it is. It doesn't matter what this number is. It matters how much we're going to make. We made 26. If we make another 18, and then in the next 6 months we'll make at least another 18. That's $36,000. It's 36% a year. I'm only doing 3 trades. That's of a $100,000 portfolio. I don't have to, we followed up one other time. We didn't change anything. We just looked at the 5 trade ideas about 2 months ago because they were already on good track. And I said, this looks fine. Let's not worry about it. So we didn't even really think about it much since then. This is a low touch, simple concept trades, very basic option strategies, and we make them all the time. Now, the trick is, though, to make them when the market is down, not at arbitrary times. So this is a little bit arbitrary, but since the 3 of the stocks that we like have been pretty much flat, it's not like there's going to be a better time to get them. They're still at the price that we thought was good 4 months ago. So I don't mind re-upping our trades on those. The other 2, I'm sure as hell not going to chase, and I don't have any particular reason to pick anything else. I mean, I actually was thinking of adding Macy's and whatever, but it's like, let's just put these 3 in for now. They're going to make great money, and we'll see how the China thing goes this weekend, and we'll see how the Fed goes, and then we'll see how Christmas goes. And if we're all alive on January, whatever, when I get back from Thailand, I get to go to Thailand, by the way. When I come back from Thailand, if the market is still alive, then that'll be good. The market tends to crash when I get out of my chair, though. You guys should know that. So it's going to be a problem because I will be out of my chair for a very long time. I'm leaving for Thailand because PSW Investments is doing a thing there. Very unwillingly, by the way. This is not a trip. This is not the way. I wouldn't mind going to Thailand, but not the way I'm going. I'm going straight to Thailand. Christmas Eve, I have to fly to Thailand. If you leave Christmas Eve, you get there on the morning of the 26th. So I'm entirely, so Christmas Eve I fly. Christmas Day doesn't even exist to me. I'm going to spend the entire day on an airplane. And I'm going to arrive in Bangkok on the 26th. On the 27th, first thing in the morning, I have to go to Buriram, which is up north a bit. I have to take another flight. Then I come back from that the next day on the 28th. And then I will go back to Bangkok, and we are staying in Bangkok until I leave on the following Friday night. So I'll be New Year's in Bangkok also. I wish I was going to be having a great time in Bangkok on New Year's. I'm sure I'll go out New Year's Eve, but mostly meeting. The problem we have is we've been working through Hemp Boca, one of the companies PSW Investments invested in. We've been working with the government of Thailand, and we won, surprisingly to us and everybody else. We've been selected to be the contractors who are going to develop the CBD industry in Thailand, and we have been granted permission to set up a farm and begin farming hemp and cannabis, and then to bring in manufacturing. So fortunately, one of the reasons we won, I also have a manufacturing partner, New Age, another PSW investment, is our manufacturing partner, and so we're bringing them along too, and we're forming we're being a whole team. And we're going to get our first farm in Thailand to grow hemp and grow marijuana, and then we are going to set up extraction labs, and then we're going to set up a retail operation to create products. And this is not through the country of Thailand. We're not selling it to people. We're selling it to the National Health Service, and we have 3-year exclusive contracts to sell to them. So it's a huge opportunity. It's going to be an amazing thing. But the problem is they don't like to close. They don't like to do contracts like this without meeting everybody. So they're pretty much demanding I come out there and actually physically sit down with them and talk and shake hands and such. And so I'm going to do that. Because I'm not going to blow this deal. It to me is like crazy. I'm like, I could really just e-sign this and we'd be done. It's like take 5 minutes, but I have to go to Thailand basically and meet everybody they want. They want me it's very important for them when they do a business deal. Like when they announce a business deal, they have pictures of the business deal and all the partners shaking hands and things. And it would just be really bad form not to go apparently. So it's going to be crazy. It's a huge opportunity though. It's just, unbelievable potential on this thing. So I've been very wrapped up in that lately. I've been constantly on the phone and all the phone calls, like they're on the opposite side of the earth. So every day is night and night is day for them. So I'm at the weirdest hours having meetings and phone calls and things like that and conferences. It's been 3 years of this. We haven't been involved for 3 years, but on Hemboka's side, they've been back and forth and working this deal for years, and they've got we have Thai partners now in this deal, and we're very, very tight with all the agencies and such that need to be doing this. So it's a huge amount of work just coming to fruition right about now, and we're going to be getting a whole new round of investors for this stuff too, because it's gigantic. So it's very interesting. But anyway, so the bottom line is I'll be in Thailand. The bottom line is I'll be in Thailand from the 24th, which is Christmas Eve, and I'm coming back January 4th. So I'm away for much of 2 weeks, and I will be attempting to at least publish posts and try to comment on things, but I'll be very delayed in comments, and I'll do my best to keep in touch and everything. But we're certainly not going to. So we will do next week's webinar, but not the next two after that. Obviously Christmas Day. Actually, Christmas Day, New Year's Day, the market's closed anyway. So neither one of those days would have been days that we're doing anything. And actually, of all the weeks in the year to go away, this is the best time for me to go away because it's so slow in chat at that time of year that may as well be closed. So anyway, that's where we're going to be. It's crazy. So where was I? All right. Anyway, so we have these 3 new plays. So obviously, just go to philstockworld.com. Today's report has the 3 new trades, and they're set up to make $18,000. And it's not that much effort. And it's a kind of effort. It's exactly the kind of trades you want if you have other business like it, and you have to be in other places. Now, what we are doing that's much more important, and what we're going to talk about today for whatever time we have in between the Fed crap, future. The other day, where was that? Is that Tuesday? Or was it Monday? Tuesday. I want to see where I said it because it's something. FUT. Yep. Future. Okay. This is what made me think of it. So I'm doing the news, and we talked about. All right. So palladium is shot up because of power cuts. By the way, these are coming back online, so palladium should be going lower. Where's metals? Palladium still high. I think you can short palladium at 1850 at this point, although it's very risky. But the problem was because South Africa had power cuts, and they're actually addressing the issue. So it's not going to last. And this is right now priced. Look at palladium over the last here. So South Africa's been having these power problems, and it's been hurting the mining industry, and they're going to have a shortage of palladium. That shortage is going to be shortage for a while, but this is anticipating a longer term instability than we're going to have. So somewhere around here, it's going to top out and start coming back down. It's interesting. I don't play palladium, but it's just something you could play. Oop, where was I? Oh yeah. So news. So obviously I read all these things. I don't just post them. So I'm reading this one on McDonald's with the fake meat and Boeing with their new planes and liquefied natural gas. Oh, that's something we should add, the LNG operations. Virgin Galactic, the iPhone 11, autonomous grocery delivery. So that made me say, I'm thinking we should put together a future is now kind of a portfolio, because this is kind of crazy. I mean, we've got stocks like Virgin Galactic that's going to be literally next year taking people to space, and they're building a space hotel, and there are and of course Elon Musk is doing his thing with SpaceX, and then we've got all these. I mean, we have solar energy, we have artificial intelligence chips, we have quantum computing. It's like, obviously this stuff is the future. This is sort of like, if this is like in 1970, if I was saying, they've got these silicone chips, and it's going to be a big thing, and then they've got these flat TVs are coming out, and that's going to be a big thing, because who wants a big wide giant TV when you could have a little flat screen that does all that? All these things are kind of like, yeah, of course, they're the future. The trick is picking which company is going to be the company to play, but not the technology. It's not a question of, they have gene editing, this CRISPR company, right? Is gene editing. Now, they're not necessarily going to win, just like in 3D printing. DDD was one of the first 3D printing companies. They did not win. They got their ass kicked eventually. Being the first doesn't make you win. You have to eventually be the best. And I've always said about 3D printing, I said my theory on 3D printing, and frankly, I would have picked Hewlett Packard, because Hewlett Packard has billions and billions of dollars. So Hewlett Packard doesn't care if they're the first to market with 3D printing. They'll just buy whoever does well, or if they can just copy the technology, they'll copy the technology and do it themselves. HP didn't invent the laser printer, they just perfected the laser printer. They weren't the first by a mile. They were not the first laser printing company. When I bought my first laser printers for my offices back in the day, they weren't even a choice. I think an Apple laser writer was before HP started making laser jets. Yeah, I'm pretty sure there was no such thing as a Hewlett Packard laser jet, but when the Apple laser writers came out. And Apple, obviously, they got out of that market. It didn't work for them. HP kicked the crap out of everybody else in that market over time. So being first doesn't make you the winner. And so we're going to have a new technology portfolio, or I want to call it a future is now portfolio, but we're going to change horses as the race develops in various things. We're not going to just stupidly stick to whatever we pick, because you don't know who's got the best stuff. But it's fun, and it'll make for an interesting portfolio. So I like the idea of, like, let's put, let's say we want to take $50,000 or $100,000 and say, okay, we'll bet a little bit on, we'll allocate about $5,000 to 20 different companies and see what happens. I think that's cool, and I think they're fun to watch, and I think it'll keep us on our toes as far as watching these things as they develop. So the ones we talked about so far, what did I do? That was yesterday. Oh yeah, I was trying to find out where we started talking about it. Now we get back to today. So I was looking at Virgin Galactic Space, Tesla. Much as I get pissed off at Tesla, they're still quite the innovative company. I mean, they're very cutting edge on battery technology and on the cars, of course, and the solar panels. So there's a lot of he's a visionary guy, that Musk, and whether he's right or wrong, it's still, they could hit something. They keep trying. He keeps trying. You got to give him that, right? He's like Tucker, who was a very big car innovator back in the day. Went bankrupt, you know, had a tragic end, but you know, he tried. He kept coming up with stuff, and a lot of that stuff is being used today in cars, but they were good innovations, just couldn't pull it off as a company. Now, that doesn't make for a good investment, but I think there's ways we can play Tesla bullish that are also going to take advantage of the fact that they're way too overpriced on the option side. We got Beyond, which is a hamburger, you know, Beyond Meats. And again, I'm not saying definitely them over Impossible. We'll have to make these decisions and look at them and say who's not too unrealistically priced and which one seems to have a better platform. Beyond Impossible sort of has done a better job of going after the actual hamburger market, whereas Beyond is more focused on being a meat substitute, like, you know, like in the grocery stores and supermarkets and things. SunPower, my favorite solar panel maker. I think they belong. Lockheed Martin, closest to fusion of all the major companies. I mean, obviously that's going to be world changing when that happens. And they may not be them, they may not win, but they've got other attributes that are good, and this is a very important project to them that they're working very hard on. Disney, you know, it's funny to say Disney because you're like, well, Disney is like a 100-year-old company, but they are also the future of entertainment. They opened this weekend it's not even a ride, it's like an experience, and that sounds like a commercial for Disney. My nephew, in fact, is one of the people in charge of this ride, or whatever you want to call it. But so he works at Disney. He used to be in charge of the Twilight Zone Tower of Terror. That used to be his ride that he was the boss of. And you know, it's a big thing. There's like a couple hundred people work on these things. So anyway, so now he's on this because he's a good guy. So they put him in. He's not in charge. He's one of the people who are in charge of the Star Wars experience. And it's really intense. It's like you go into the place, but while you're in line, stuff is happening. You go on the ride. The ride is like a half hour plus of time, and it's not like you don't get into like one thing. It's like you go through a thing and stuff happens, and then you get attacked by not the rebels. You get attacked by the whoever the hell, the resistance. And then you're in prison, then you're in some kind of transport that you get hijacked, then you get out of that, then you go to jail somewhere, then you're somewhere else, and then something else happens, and then you get another ride. It's crazy. But people coming out of there are like, oh my God, that was like the greatest thing ever. And it's this immersive, interactive, gigantic experience. They've got, at one point, they have 100 robots, animatronic, like Hall of Presidents, animatronic robots, because you can't have 100 actors standing around for every single person's experience, but they have 100 robots standing around to entertain you. It is just madness. And so you got to realize, like, okay, fine, this is the future of entertainment, and just because they've got one foot in the past and one foot in the future doesn't mean that they're going to lose. And also their streaming services, again, innovative and taking over, and they already have 22 million subscribers already, and like I think they launched in October, and they've already got 22 million signups. You cannot cut this company down. They are going to be there in whatever form entertainment takes down the road. So I decided to include them because obviously entertainment is always a big thing. Oh, also they're opening up a Star Wars hotel, and the Star Wars hotel, from the minute you check in, is an interactive experience where you will be checking in and they will give you a mission, and you will be interacting with actual actors in the hotel and around the hotel, and you will have to do stuff, and there'll be things happening everywhere you go in the hotel. It's crazy. I mean, it's just like a whole new way of entertaining people, and it's Disney. So I mean, you can't ignore that. Xilinx is a water treatment company. Water is going to be a huge problem down the road. It's one of those things that we kind of ignore, but There's going to be water shortages in many, many places, and water treatment systems and water. These guys are into water efficiency. I mean, treatment is one thing, but they're into efficient treatment systems, which is good. Waste management, again, another old style company, but they are always innovating and changing. And the concept of waste management is becoming critical in a lot of places. You know, so that's also, I think, a future thing as well as a past thing. CRISPR is your gene editing, of course. IBM, AI, you know, Watson and such, and robots. That's going to be a big thing for IBM. Qualcomm, again, my favorite is Broadcom, but Broadcom got bought up. And Qualcomm is just really been impressive lately. They're on a roll with the patents, and they've been bringing all this technology to bear. It's really, their portfolio is great. They've already gotten well into the 5G, very well entrenched in 5G. They're going to be on top of the next wave of technology. So you need them, and the Internet of Things is going to make all this stuff much more important than it is now. ISRG is, again, they're not that new, but they are surgical robots, and they are still growing and growing and growing. And frankly, from the results I see on surgical robots is it's almost malpractice to have humans operate on people at this point. That's how good those things are. You know, it's like, it's why are you using humans when you could be using a robot? It's hard to say what that would compare to, but I mean, it's just like, this is a problem when you think about, you know, you talk about like robots taking things over and jobs over, okay? It's like autonomous vehicles. It's like, if a robot is going to have less accidents, why would you let people drive? It's irresponsible to let people drive when robots drive better than people. If robots fly planes better than people, then robots should fly planes. You're into safety issues, right? When you're at food factories, if you have robot food factories, there will be less contamination of your food. Therefore, you should have robot food factories. So a lot of stuff like that is going to the decisions will get made because the pressure is going to come down from a safety aspect and a benefits aspect. And then there's places like mines where why should you have miners when robots can do this without risking people's lives just to get some materials out of the ground? A lot of job displacement by robots is going to be to the benefit of people because these jobs are terrible jobs, or the jobs can be done much better by the robot. It can be much more efficient. It can be safer for the people involved in the process. But it'll always be like, where do you draw the line? But that doesn't matter. Surgery-wise, though, ISRG, they have these systems, and what they do is, as over time, they get approved to do more and more procedures. And every time they get a procedure approved, it's not always the same machine, but every time they get new procedures improved, they start a new line, they get new machines, or they have the same machines doing different procedures. And that's their growth pattern. Their growth is really a lot stronger than it looks because the same machines can do multiple functions. So, in other words, one day, your town, even if you're far away from a hospital, your town could have a robot surgical center that will be able to handle a lot of routine operations. So you won't even have to go to the hospital. You're just going to go to a place where a robot doctor is going to fix you up. And that seems crazy, but it won't seem crazy to you when you go to the big city hospital and a robot doctor fixes you up there anyway. So you're seeing the same doctor, whether you go to the close hospital or the far hospital. You may as well go to the close hospital and see that robot. It's the same robot. It's a clone. They're the same thing. So that's I mean, it really, and look at what we're talking about here. All this stuff. I mean, it's like, this is incredible. Here we are in the year 2020. And all this stuff is just like stuff we're talking about. And we're going to add, hopefully we're going to be adding flying cars to this list very shortly, which is really going to turn out to be a big drone. It's not really what we were thinking of. I don't know what we were thinking of when we thought of a flying car. It wasn't going to be something with tires that flies. That would be silly. But it's going to end up being some form of a drone, most likely, that you just get in. And we all have drones. That's the thing. It's not that unsafe. You've used drones. You've seen them. I mean, sure, they bump into things a lot, but they wouldn't if a robot was driving them instead of your clumsy fingers, right? So, so we're going to have autonomous robot drones that pick you up and take you where you want to go, literally pick you up and take you where you want to go. We're going to have, obviously, drone delivery services. Now, I was iffy about, you know what, I'm sorry. I did say Amazon should be in here and I forgot. So Amazon should be on this list because you really can't count Amazon out. They are the future of shopping, their drone delivery. In fact, didn't I leave that off somewhere? There, right there. I heard that. I guess we have to consider Amazon as a smart home and future shopping play because they're going to have drone delivery. They're very big on the smart home stuff, and they've got future shopping, and they've got the Alexas that spy on you, so that's also very future-y. My brother and I were talking about we were talking about, like something about Belize or something like that, and my brother picked up his iPad, turned it on, and there was an ad for Belize. And there was no possible way anybody had said anything about Belize until he picked up it, right before he picked up his thing. He had not previously been in his iPad looking for something about Belize. It came up in a conversation we had right before he picked up his iPad, just out of the blue. It wasn't like something where he was been thinking about Belize. Yet, boom, there it is right there on his iPad. So either the iPad was listening or the Alexa was listening that's in the room and somehow communicated that to Google when it opened or whatever a chain of events it is. Oh, no, I'm sorry. It's not Alexa. We have an OK Google. We have that thing. It's not Alexa. So it's whatever you say, OK Google to. I forget the name of that. So he's got one of those. And so I think that thing communicated somehow to his iPad and placed that ad or something. I don't know, but it's really freaky. I gotta tell you, it's a little disconcerting that things you say are being monitored by your equipment, and they decide on how they're going to advertise to you and such. And and I know, and this happens easily. It happens a lot when you're doing something like if you write an email to somebody about going skiing, all of a sudden the ads it's an email. All of a sudden, you write an email to someone about going skiing. All of a sudden, the ads on your system turn into ski ads. That all of a sudden, all of a sudden, these ski resort ads start popping up for you, and it's like that's spying on you. That is, I mean, they're listening to you and watching what you write and listening to what you say, and then they say, okay, well, he wants ads on that. Now, I guess you could say that's useful, isn't it? I mentioned skiing, so I might be interested in looking at ads for ski places. It's not wrong, is it, to be useful? It's a very tough ethical thing. Fed, okay. Last Fed meeting of the year. Dun, 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 dun. Here it is. Nothing yet. And the market looks like down 62, S&P up 0, flat. That's about as flat as you can get. And what do we think the Fed's going to do? We think the Fed is going to hold steady, certainly not lower rates. They should raise rates, but they don't have the balls. Oh.
The committee judges the current
Unchanged. Appropriate.
The median forecast no longer sees a rate hike in 2020 that had been built into the September forecast. We have a new forecast this year.
They don't.
And there's no longer a rate hike built in.
They don't see a rate hike built in.
Several have multiple rate hikes built in, but only one is the median of 1.9%. The long run rate for the funds rate remains unchanged at 2.5%.
So the Fed funds are now 1.5 to 1.75, yet the Fed still maintains the normal rate is 2.75. I don't see, or 2.5, sorry. So they're supposed to get rates up a point, but they have absolutely no time frame for it. All right, the rest we can read. This guy's got no insight. All right. There we go. Oh, it's a projections. That's always fun. Let's take a look at that. Wow, nice short. Information indicates that the labor market's strong, remains strong. So it is strong, remains strong. Economic activity is rising at a moderate rate. Job gains solid. Unemployment rate has remained low. Household spending is rising at a strong pace. Business fixed investment and exports remain weak. On a 12-month basis, overall inflation for items other than food and energy are running below 2%, because who eats food or consumes energy? Excuse me. Market-based measures of inflation compensation remain low. Survey-based measures of long-term inflation is a little changed. Consistent, the committee seeks to foster blah, blah, blah. The committee is maintaining blah, blah, blah. Committee judges the current stance of policy is appropriate to support sustained expansion of economic activity, strong labor commissions, blah, 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 blah. Committee will continue to monitor the implications of incoming information, of course, including developments, da, 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 da. In determining the timing size of the Fed funds rate, the committee will assess realized expectations, blah, 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 blah. This assessment will take into account a wide range of information, blah, 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 blah. Wow. They really could have wrapped that up in like a sentence. Okay. Voting for the monetary policy were everybody. No dissent. Rate steady, no dissent. That's interesting. That's I would think that would be a little bit bullish for the market, because the fear would have been they had some dissent. So what do we got here? This will be the interesting part. So these are the Fed's projections. Change in GDP, declining. September projection was the same. Unemployment rate, flat, rising, touch, more, really flat. September projection had it rising more. Inflation, well, if it's 1.5 now and it's going to 2, that's a pretty big rise, but 2 is their target. 2 is what they call successful. Core inflation, 2. Fed funds rate. Oh, that's a long time frame. They're saying next year there's going to be no change. That's what they're telling you now. They're not raising the rates all next year. That's why I said this is bullish. That's bullish. I don't see how that can't be considered bullish. The unanimous Fed is not intending to raise rates for all of 2020. I mean, that's freaking amazing. And they're barely going to raise them in 2021 or 2022. This is normal. 2.5 is normal. They're not going to get to normal for years. But it's interesting that they're doing this while the GDP is declining. It shows you how important it is for them to get those fund rates back to something that they can deal with it, because this is unsustainable where they are now. Yet they want everybody open. And you know what? Nobody's objecting, because nothing bad seems to happen. You keep thinking like that these rates are going to wreck the economy and cause all sorts of problems, but they haven't. So I guess they're going to let things go and see how everything progresses. All right, let's see if we got any questions. Okay. Abel says, what do you think about Cisco? I love Cisco. I think Cisco is a fantastic Internet of Things company. And honestly, I was going to put that in my future thing, but I thought there might be a more relevant company but Cisco's hard to beat, and it's possible that I may end up deciding that Cisco does belong on that list. I don't know where they are lately. I certainly look at them from time to time, but I don't think they were cheap. I think that was a problem. So I think we just haven't bothered. Oh, now they're cheap. Look, they're much lower. Well, I don't know if that's cheap in particular, but they are lower than they were. And this is around where I'd pick them up. I think 40 is about where I really would like to see them. Let's take a look at what that's Twitter. That's not Yahoo. That's not Yahoo. That's Yahoo. CSCO. Yeah, 189 billion is like 17.6. That's not. It's getting there. I can almost bring myself to pay 17.6. So if it's 17.6, that means we should see $10 billion in earnings on the bottom line. So let's see what we got here. Yep, 10 billion. And they did 10, 10, 11. And how are they doing this year? I'm sure they're fine. Yeah, oh, look at this. 3, 6, and 8, and they're easily going for 10. It should be 11 again this year. So I don't know. Seems good to me. All right, let's call Cisco a winner. Now the question is, do they properly represent? Oh, it's like they're talking to me. See, there you go. It's exactly what I'm talking about there, right? It's like they aim this at me. Cisco unveils a plan for building the internet for the next decade of digital innovation. That's so my question I was just about to say is, but are they really the company that's going to dominate for the next decade? Is it really the one we want to put our money into now? You know, we know they have dominated and that they're going to be solid. They'll be a player, there's no question, but they'll be a player the same way that Microsoft has web services. They're not kicking everybody's ass. They're doing well, but they're not the ones. Amazon's really sort of dominating the web services right now. You know, and Google really got smoked by both of those guys, unfortunately. So anyway, so tailor-made article, but the problem is it's on the PR Newswire. By the way, I always pay attention to that because it's like, who wrote this article? The PR Newswire, that means Cisco told you that Cisco plans on building the next decade of digital innovation. Doesn't mean anyone else thinks so. And Cisco says that their new silicon software router products will change the economics of the internet. Now, a lot of that might be true because they really do make good stuff and they are always innovating. But we'll see. So, how much is their dividend anyway? 3%. It's all right. But yeah, so Cisco, if you remind me in chat, I think that's a good idea. It's actually one we should do is Cisco. Add that. Of your trades for next year, Melda says, what's your favorite play and least risky, please? Oh, favorite and least risky? I would say favorite SKT. This is that F, marry, kill thing, right? So my favorite is SKT. So I marry SKT. Oh man, oh look what you're making me do. All right, so it's marry SKT, FWBA, and kill LB. So of the three, I would have to say LB is the riskiest, simply because it's kind of a self-fulfilling prophecy. When you are a company with a large amount of debt, you could be managing your debt like for example, like oh, I forgot the name now. That telephone company that's killed us, Frontier, like FTR. So you could be a telephone company or any company with a huge amount of debt. And Frontier bought a lot of assets from Verizon and took on a large amount of debt. And they didn't think that was a problem because they have a plan and their plan is to pay it down. And they know it's a diminishing asset. That's why Verizon sold it. All right, so Verizon, I don't know if this thing's going to go far back enough. Well, let's say back here somewhere. Verizon sells Frontier their wireline services. And Frontier says, this is fantastic because we're a little pissant regional phone company that makes lovely amounts of money. They were trading way up here, and they make lovely amounts of money. And they said, but here's Verizon, who wants to get out of the wireline game. You know, these guys are regional carriers. I'm sorry, they're rural carriers, Frontier. So they've got wireline all over the country. You know, they've got old technology because they service outlying areas. So they're experts in old technology. They've got all the technicians to handle that kind of stuff. That's their business. They know it well. They know how to reduce the costs on it and squeeze every penny out of those old lines. They know how to boost the transmission speeds to get Wi-Fi over the old copper lines. You know, they're good at all that stuff. And obviously not that Verizon isn't, but Verizon would rather put new fiber in than sit there and muck around with the copper to get another 10 megabits per second out of copper. That's not their priority. Their priority is to just throw the copper away and lay fiber down all over the place. So, what happened is Verizon actually decided to dump all of their fiber. It's in major states. Verizon is just dumping, and they're going all wireless basically down the road. 5G is going to be, a lot of companies are relying on 5G to go all wireless. So anyway, so Verizon puts up some of their assets for sale, and Frontier is able to buy California, Texas, the entire state of California, the entire state of Texas, the entire state of Florida. They bought all of Verizon's wired business. So in other words, all their fiber, all their cable, all their copper is all owned now by Frontier. They bought it for $16 billion. The business generates about $1.8 billion a year, which means effectively Frontier is going to have it paid off in 10 years using the cash flow from what they got sold. Now, people are cord cutting, right? You've heard that expression. So people are moving away from wired services, but at a manageable rate where Frontier said, okay, we're going to lose 2%, 3%, 4% of our customers each year, but it won't affect, you know, it's still enough money. So in other words, we'll go down from, how much is that? Okay, if we're getting, I'm talking profit, not revenue, but I'm just being simple about this. So we get right now 1,600 in billion. I mean, but anyway, so it's 16 billion, 1.6 billion in profits this year. Then times 0.97, let's be, so then times 0.97 times 0.97, 2 years times 0.97 times 0.97 times 97, I did 697. 7 times, is that right? Yeah, okay, so they're still 1, 2, 3, 4, 5 years later, they're still getting $1 billion a year. Okay, and they will have already paid off half of their investment. They're still getting $1 billion a year. But of course, they have a plan to lower the cost, and they have a plan to increase the revenue and to be able to utilize the fiber to do other things. And they think they're going to get more business revenue because in the long run, and they're probably right, in the long run, businesses don't give a crap whether they get their internet on 5G or on the old wire system. What they care about is how much they're spending. And Frontier is going to be perfectly happy to service those businesses for half the cost of 5G. All right, but unfortunately what happens is now that they're executing the exact plan that they said they were going to execute, what's happening is as these 0.97s come in, their business drops and it looks scary to people, and they look at their debt burden, and they look at the amount of debt they've got to repay, and they look at the amount of revenues that are coming in, and they look at what they call the customer churn. The customer is leaving because there are customers who are modernizing, going for better stuff. There are still tons of customers who aren't, but the ones that can afford to switch and go to the better services are going to the better services. And so they start dropping. Then because they're dropping, people start the shorts start hammering on them and saying, well, you're going to fail because of this, and you're not going to have the money, and now and then the cost of their borrowing goes up because the banks read these articles too, and the banks say, oh, no. If you want to borrow money from us, you've got to pay this much. But Frontier's projection said they would only have to pay a normal amount for borrowing. Now they got to pay an extra point. That extra point, though, adds 2 years to their repayment cycle. And in those 2 years, they lose 3% more business in 2 more years again. So now it's adding on maybe a 4th year to their repayment cycle, or a 3rd. So it all spirals together and really can hammer a company. So going back to LB, it's the same kind of thing. LB is spending money. They redid things. They threw out different brands. They reorganized themselves. But when you do that, you're obviously taking a big hit to profits. And while they're taking a big hit, and they canceled their fashion show. They no longer have this fashion show because it's all sexist now. So anyway, so while they're changing their brands, or while companies are doing things like that, if the sentiment on the company turns negative, all of a sudden the company can get in real trouble. They can actually be in actual trouble over rumors of being in trouble. Like a bank run, right? Like that Jimmy Stewart thing, It's a Wonderful Life, where you just tell people the bank is running out of money, and the people run to the bank and take out their money, causing the bank to run out of money. There was never a problem in the first place, but if you say there's a problem, there can become a problem. So in the case of limited brands, they're experiencing the same sort of issue. Okay, where just the fact that people think there's a problem is causing them to have a problem. So since I have the choice of those 3, I'm going to have to kill LB, because it is possible that this will end up causing them to have to restructure or do something. And that's unfortunate. But overall, I don't think that's going to happen. I don't really think that's what's going to happen. I think they'll get through it, and I think it'll be okay. But I thought that about Frontier too. And so far, no improvement in sight. To the point where we didn't even go back to the well on Frontier. Somebody was criticizing me for going back to the well on LB, but on the whole, LB has been up and down, and we've been fine. I mean, we've actually done pretty well on LB, because every time they go down, we add more, and every time they go up, we sell some off. Why are you doing this? It's gallery view. So LB's been a jagged down slope basically, but we when it comes down a bit, we add more, and then we get out, and then we come back and we add more, and we get out. Now it's down, we're going to add more, and it gets out, and then we'll sell again. So it's been fun to play with basically, but it hasn't had the big payoff we've been looking for. So anyway, when the sentiment turns that bad on a stock, they can turn bad, and it's not going to recover itself. So that's my choices there. I'm looking at, Robin says, I'm looking at Cisco bull call spread. I saw the 2022 40 calls for 765, and the 4250 calls for 645. Does the 40 call have an advantage? Okay, well, as a rule of thumb for me, I'll pay 50% of the cost of rolling down. So in other words, you're saying the 4250 is a 645 and the 40 is a 765. So it costs you $1.20 to roll down 250. I think that's worthwhile. You're paying $1. If you believe that Cisco is going to be higher than 4250 in the first place, why would you not spend $1.20 to make another $1.30? So Cisco's at 40 something now. So I would rather spend the money to be a little bit more in the money. You're saying you could buy, and I would probably be more aggressive than that, though. I'm not sure what you're looking at exactly, but the $40 calls are half in the money, and you're paying $765, right? So let's take a look at your logic here. See, now, if you want to be the house, all right, you've got to think about, how can I sell as much premium as possible? If you're paying 50% premium on the calls you're buying, you're already not really being the house, are you? You're being half of the gambler. So let's see what we've got. So the 2022 40s are, I don't know what you're looking at. You said 765. I don't see how you're going to get it for that price. Oh, it's over here. Oh, sorry. No, 775, whatever. All right, good. Now, so I'm going to look now at the next one down. I have, if that's 775 and that's 940, that seems reasonable. That cost me $1.70 to go down 250 more. What's the one below that? The one below that, I'm at 940, and this is 10, it's probably more than 1060. It's probably more like 11. So that's $1.60 to go down 250 there. So somewhere around here is my sweet spot, and I guess I might go for the 40s because the 40s are going to be more liquid. As a rule of thumb, the 0.50 spreads are not going to be very liquid. So you know it's always annoying to not be in a liquid spread, and you can tell by how wide the spread is also. This one's 70 cents, that one's 70 cents. That's not so bad. This one's $1. So you can tell you're getting less liquid too when you have that kind of a width. When you get up to one that's at the money, like the 45s, your spread's only 35 cents. So meanwhile, and there you go. At the money, the 45s are $5.50 or $5.45, or at least five. I'd say $5.50. So if I can go with a 40-45 spread, I don't like that though, because I'm spending. I don't like. It's too tight. I'd rather sell. So now, what am I willing to sell? These are $5.30. These are $4.60. That's $1.30, and these are $1.30 also. Ugh, that's tricky. Okay, you want to sell as much premium as possible, so you're kind of stuck selling the 45s for $5.50. The question is, what should you be buying if you're going to do that? And if you buy the 40s for $7.75, you're paying $2.25 for a $5 spread. That's not terrible. But is our premise really that Cisco's only going to be at 45? No, not really. We think it's going to be higher than that. What if we do this? So what if we do the 4250 and sell the 50s? That's going to be 650 and minus 365 was, let's say, 370. 370 to get to 650 is 280, right? So that's 280 on a 750 spread. I think I like that better. And then I'd be a little bit more aggressive in the puts. I'd sell the 4250 puts. So let's say that you buy, let's make sure we get the math right. So what I'm saying is you can buy the 4250 calls, which are in the money, but only by a couple of bucks, but you buy the 4250 calls for 655 sounds right. Okay, so 655 split in the middle in that. So 655, you're buying the calls, the 4250s. You sell the 50s for 370. So minus 370 is 285. And then you sell half of the 4250s, which are, well, there's 6 over here. I'd say at least 580. So let's say 580 is divided by 2 is 290. So minus 290. So effectively 0. So minus 290. So effectively that spread is 0. You know, if you're doing 2 of these, the 4250 spread minus, and then you're doing half of the 4250 short puts. So the net cost of that trade is 0. So let's say you did 10 of them on the long side, you'd sell 5 short puts, obligating you to buy 500 shares of Cisco for 4250, which is roughly $20,000. So that's your worst case, is owning Cisco at 4250. On the upside, though, you have 10 of the 750 spreads, and that would be $7,500. So your upside potential is $7,500, and your worst case is owning $20,000 worth of Cisco stock. So that's kind of the way I would look at something like that. All right. So lots to talk about in chat tomorrow for sure, because we're going to go over all those future plays and hopefully see if we can start figuring something out there. And what did I want? Oh, I just had a thought of what I wanted to do and I forgot. Oh, parsing the Fed. That's right. Now we want to see if we can find the Fed statement with the changes just to make sure we didn't miss anything. Because that's the kind of thorough guy I am. All right. Well, we did this last time. This is funny. So wait, that doesn't make any sense. I mean, this can't be from last time. Twitter, are you listening to me too? This is getting ridiculous. Oh, there we go. It's crazy. All right, so see, I blah, blah, blah that, and there was nothing changed. I knew it. So they changed September to October. Very good. They said 12, and they, what? What is this? Somebody decided to make a space instead of a dash? How dare you? So funny. All right, so what did they change? Before they said, in light of the implications of global developments for the economic outlook as well as muted inflation pressures. That's interesting. They took away, in light of the implications of global developments for the economic outlook as well as muted inflation pressures. They just got away that whole concept. And now it just says the committee, well, that's because they're not lowering, but the committee decided to maintain the target rate. I see. So they're saying this was their justification last time. In light of the implication of global developments for the outlook and muted inflation pressures. So they can know, so I guess they feel they can't really say inflation pressures are muted anymore. The committee decided to maintain the target fund rate at 1.5 to 3/4. Okay, now last time it was a lowering there. Now they're saying this action supports. Last time they said this action supports. Now they're saying the committee judges that the current stance of policy is appropriate to support sustained expansion of economic activity. But what happened to the weakness in corporate spending and stuff? I know I saw that somewhere. There. Household spending rising, business fixed investment and exports remain weak. Why are we not addressing that anymore? Why do they, it says it there, but they're not. See? Well, sustained expansion of economic activity despite business fixed investments and exports being weak. Is that how they're trying to say it? Strong labor conditions, that's consistent, and inflation near the 2% are the most likely outcomes, but uncertainties remain. So now they're saying that this is really what they hit. They're saying they hit the ball out of the park. The committee will continue to monitor, blah, 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 same thing. Then say, including global developments and muted inflation pressures. You know, they're kind of a little all over the place on this stuff, and I think it's just because they're kind of bullshitting here. And then nothing changes after that, except nobody voted against it this time. Now, last time, Esther George and Eric Rosengren thought they should have lowered it. No, I'm sorry, thought they should have kept it lower. Not lower, higher. So Rosengren and George thought they should have not have lowered it at the last meeting. Now it is lowered, and they're not against the current policy. Oh, now Jay Powell's talking. All right, we'll find out what he said after the fact. Hopefully he provides a little bit of clarity on the statement, because the statement's kind of all over. I would like it to be more clear than that. Excuse me. I've had a gas already. Too much of this freaking Thailand stuff. It's getting really like too that coming to the head. Like as of this moment, I haven't even booked my airfare and stuff yet because I didn't want to go, and I said I'm not going to go unless every single thing is going to be actually signed and done. But now they're all busting their butts to accommodate me and make sure it is going to be all signed and done. So I kind of painted myself into a corner, and I'm off to Thailand. All right, I'm looking at Cisco because blah, 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 blah. Okay, we did that. All right, so that's where we stand on that. And I think we're probably going to wrap it up here because I don't see any other questions. Where Jay Powell's going to say what he says, but we're not going to do a blow-by-blow on that. So generally, in summary, we have 3 brand new plays this morning in the Morning Post. SKT. You invest $2,250. Your worst case is that you own 1,500 shares at 14, which is $21,000. That's the worst thing that can happen is you'll own $21,000 worth of SKT. It's currently at 16, and you'd have it at 14. It's a $6,000 spread. So if all goes well, you make $3,750 and by March. So that's nice, although you'll still have a little bit left on the June puts. LB, as I said, probably the weakest of the 3, but I still like them, and I don't see any reason they can't hit their numbers. This one is $11.50 spread, and it'll pay a $5,100 profit if it goes well. And the Walgreen Boots, I think, is very solid. So that was my F. This is my Mary. Wait, no, wait. No, this is my Mary. See, this is the one I think is most reliable. SKT is only an F. This one's a kill. So this one is $3,000. That's why I put the most money into it. You know, it's funny because you can actually tell how I feel about something by how much money I'm putting into it, right? We put the least amount of money into this one, but it has a nice upside, so I thought it's worth a gamble. But the medium amount of money goes into this one, and I consider that my medium play. And my strongest one is I'm saying, okay, I don't care what this one costs. I want that one. This is the bulk of our winnings. So that's where we are with that. So that's a real nice way to make some money between now and after the holidays, and we'll see how those go. We'll check back on that in January and see if they're having a good first month. And again, the trick, as noted in this cartoon, the trick is don't be the guy buying the options. Okay, be the guy selling the options. It's very funny because it's in the cartoon. It's a universally acknowledged concept that buying options is for suckers. And we're not buying options. We are selling options. If buying options is for suckers, then let me sell those options to suckers. If there's a bunch of suckers out there who want to buy options, I'm happy to sell them. And why are we able to sell options? Why? Because of this, because of these short puts. I'm promising to own the stock. I don't own it, but I promise to own it. I'm taking a call on the stock that gives me the right to own it, but I'm not actually owning it. What I'm doing is I'm saying I promise to buy it if it's below 57.50, and I promise, and someone is promising to sell it to me for 55, even though it's at 60 or whatever. Where is Walgreens? 58.50, 58. Okay, so it's at 58, and I'm saying, okay, I'm going to promise to buy it for 57.50, and you're going to pay me $3. You're going to promise to sell it to me for 55, and I'm going to pay you $5, but I'm turning right around and I'm promising to sell it to somebody else for 60, and they're going to give me $3. So on the upside, I can't lose because I have a $5 advantage over this guy for the same amount of stock. So all that can happen is that I am given this stock for 55, and then I am selling the stock for 60, making a $5 spread on the stock. Doesn't matter what the actual price is, as long as it's over 60, it's the same to me. And that would return $12,500. And obviously, if we're over 60, we're over 57.50, those expire worthless too. Now, if the market gets weak and everything is down, I don't think Walgreens will be exempt. I think they'll go down too. But then we would just roll the position to a longer date and wait for it to recover. But, you know, and again, Boots, people don't know Boots. Boots is a very powerful European pharmacy. They're very, very big in Europe. They're all over. Walgreens, obviously, you know Walgreens. It's impossible to live in America and not know Walgreens. So they're everywhere, and a huge, powerful pharmacy. Now, of course, people worry about regulations and changes in laws and so on and so forth. But on the whole, it's a hell of a business. It's not going to change. It really is going to be very difficult. Amazon's trying to deliver pills online. But realistically, I don't see that catching on, because I know that when I go to Walgreens to pick stuff up and I see the people standing at the counter for the pills and stuff, and then I'm in Florida, there's lots of old people standing in line for pills. They don't want those pills dropped in their mailbox because they have questions. They want to check on things. They also want to pick up other things while they're there. It's a whole shopping. The way Walgreens is set up, it's a whole little grocery store, like a 7-Eleven kind of thing. So it's not just to go and pick up pills. And that's, I think, the problem Amazon has. And of course, Amazon thinks that they're like a 7-Eleven. They're like, well, you can buy all that stuff here too. And yeah, you can. But, you know, we had this conversation about Amazon in general. It's just, you know, of course, there's certain things you want to get on Amazon. I buy all my tea on Amazon, because why should I go to the grocery store and pick up cases of tea? I drink a lot of green tea. So it's like, why should I go to the store, pick up cases of tea, which are heavy, and put 6 cases of tea in my car, and then have to carry it from the parking garage into my house and so on and so forth? It's like, why am I doing all this when Amazon will just drop it right at my front door for the same price? That doesn't make any sense. So, you know, heavy stuff I tend to order on Amazon. Bulky things I'll order on Amazon. I'll order, you know, if we're getting a bunch of paper towels or something like that, I'm like, yeah, come on Amazon. They'll drop it off instead of taking up half of the back of the car. So certain things I'll get on Amazon. Weird stuff I get on Amazon. But you know, going to the store and picking things up and browsing and thinking of things. You don't think of everything you need right away. Amazon does a good job of that too, but they're trying. But I don't think you're going to totally replace the shopping experience. I think people like that. And I think there's that little hunter-gatherer part of our brains encourages us to do stuff like that. Like, we get a better sense of satisfaction out of going to a store and getting the thing we want, rather than looking at a catalog and having it show up in a day or two. You know, I don't care how fast their delivery time is, it's just not the same thing. But we'll see. I mean, let them, you know, they're trying hard, and there's nothing wrong with Amazon, but other than being priced 100 times more than they're actually worth. Other than that, not 100 times, they're really 10 times, priced 100 times earnings. They're worth 20 times earnings easily, so they really only priced 5 times too high. Look, they make $22 for each $1,700 share. So that's only 77 times. You know, and they should be at 20. So really 3 times. So they're only 3 times overpriced. In a proper world, they should be roughly $650, $700 would be like okay for Amazon. They're $1,700. It's a little crazy. All right. Not that I think it's going to go down. We, you know, even in the hedge fund, we have a bet. We have the 2022 1800 2400 spread. We're selling short calls against it, but our long position is quite high for Amazon because I wouldn't bet against them. They're just way too scary to short. You know, they're doing incredible stuff, taking over incredible parts of retail. The financials are growing at a huge, look at this. I mean, 107, 135, 177, 232. That's 60. That went up $60 billion from the year before. I don't think they're doing that this year. This year they're going to hit their 240, but then Christmas is 70 something, so 240 and another 10, 15, 255. See, it's only 255. So let's say they do 260. Let's say that has growth too. Let's say 270. It's still way slower. They had a huge burst here, but it's not continuing. They're going to be 260, 270 this year, and then who knows what. But it's funny though, because you're adding $60 billion to last year. How can you possibly think that's a failure? There's hardly any companies in the world doing $60 billion of business. Boeing, $100 billion total business. Amazon's adding that in a year. And Boeing is worth $200 billion? $200 billion, yeah. So Boeing's worth $200 billion. So Amazon, you gotta give them props for like justifying where they are. It's like they just added a Boeing. Not to the bottom line though, because profit wise they're way thinner, but conceptually it's just that volume of sales is just incredible. So it's kind of silly to expect them to do better than that. That's phenomenal growth. I mean, it's but and also think of how that machine. Think of how that machine is just crushing everything else and taking all that 60 billion comes from somewhere. That's what that retail apocalypse stuff is all about. It's like they're taking $60 billion worth of business. It's not new business. They're taking it away from somebody else. Toys R Us, for example. So it's all connected. Anyway, so we're going to call that a day. I think there's plenty of stuff that we covered now. We'll look at the news spreads. We'll put tomorrow, we'll definitely, but tomorrow and Friday, we'll discuss all these new plays and see if we can set up a new portfolio with stocks from the future. And we'll get through it. And then we'll do another webinar as normal next week and the week after that. And Christmas and New Year's, no webinar. And then I will be back with so much stuff to tell you after, I guess on the 10th or whatever it is of January when I come back from Thailand, if I'm even awake, if I even know what time and day it is at that point. It'll be interesting. But meanwhile, yeah, enjoy, and we'll see you guys next week. Okay, thanks.